I'm Ann Byer with Keller Williams Real Estate.
And I'm Terry West with Draper and Kramer Mortgage Corp.
Today we're going to talk to you about the difference between a conventional mortgage and a government-insured mortgage. And we're going to talk about it right now.
Thanks, Ann. So, you probably heard the words Fannie Mae, Freddie Mac, conforming, conventional, government. So these are all different names for different types of loans programs. So what we're going to talk about today is Fannie Mae and Freddie Mac. And they are called conventional loans or conforming loans. What do they mean? These are the people that set the guidelines for pretty much the whole industry. And the guidelines are what they go by to approve you for that mortgage. So Fannie Mae states that, okay, to get a conventional mortgage, you have to put 3% down minimum. Your credit score has to be above 620, and your income has to be at 50% or less to qualify for that program. And then
50% or less of what?
Of your debt. So your debt versus your income needs to be, your debt needs to be 50% of your income. So that sounds kind of high, but anyway, we work that out, and that's what conventional means. And then we have Freddie Mac, which kind of follows the same guidelines as Fannie Mae, but could be a little different here and there. So they compete for your business. Now with Draper and Kramer, we are a direct lender with Fannie Mae and Freddie Mac. And what that means to you is that when we go to price your interest rate and quote you an interest rate, we're going to get you the best that's out there because we're dealing directly with Fannie Mae and Freddie Mac. Now, there's another type of loan called government loans. So in the government loan end, we have FHA, which is your Federal Housing Authority. We have USDA, which we talked about in another segment, which is your zero down program. And we have your VA loans for veterans, which is the other zero down program. With FHA, there is a down payment, okay? They want 3.5% down, but they do have some other caveats with maybe possibly a lower mortgage insurance payment on there with that program versus some others. So
how do I decide, Terry? It's too complicated. How does anyone decide?
Well, that's where I come into play. So I'm going to take a look at your income, your assets, how long you've been at your job, what type of income and job you have, how much down payment you have or not.
And your credit score, right?
And your credit score. And I'm going to put all those things together, and then we're going to have an actual discussion. Okay? Well, here's where you fit. And maybe this is your better scenario than this other program. I'll either give you a choice or I'll say, well, considering all the things all put together, this is probably your better way to go. And you'll make that final decision. So
I've seen Terry with clients, and she is masterful. I mean, it seems so overwhelming, and you just don't know it. It's just so complicated, and people come out and say, oh my gosh, this is great, I know what I'm doing, and let's go buy a house.
And I'm here to make it easy, smooth and easy for you. But the most important thing is to have that first discussion so we know where you're at and I can service you best.
Thank you, Terry.
Thanks, Ann.
Remember Terry for your mortgage.
And remember Ann, your real estate agent.
Your local connection.